Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over some information on Twitter. There's a good article on oil that I want to touch on, and obviously a bunch of other information relating to the commodity bull market and stock market, and all the topics I like to follow and give my opinions on. So yeah, let's dive in. I'll give you my opinions. And if you want to follow me, it's at @finding_finance. So we've got this article here, and I completely agree with it. And this is where I'll say my entire paradigm is focused right here. And I do think Jeff Curry, I know some people don't like him, but I think he's probably the closest to being right, the closest to my viewpoint. I'll just say that. It says oil to face a serious supply problem in 2024 as production capacity runs out, Goldman warns. And Goring Rosenzweig also has a very similar viewpoint. And if we kind of go in here and check out the article, a couple of things I want to touch on in the article. It says, basically Goldman's bearish on all the asset classes except commodities. The bank forecasts a 43% gain as supply shortages bite. It says Biden's and Min SPR refill floor is 72, despite a near consensus that Chinese oil demand will hit record highs in 2023. They think that not only will oil rise back to $100 a barrel this year, it will rise much more in 2024 when it will face a serious supply problem as spare capacity runs out. I completely agree. I think their time frame is dead on, and that's exactly what I think is happening. But here's the thing: the markets are forward looking. They're gonna front run this. The markets are. So the markets are gonna front run this. They're gonna obviously get in here and start buying oil before the actual problem hits. So I think everything is lining up for a gigantic bull run end of 2023, like the second, I'll say the third and fourth quarter for sure, all the way into 2024. And this could be that big move, the third leg that we've been talking about in Elliott Wave. So I think it's coming, and I think everything is aligning properly. Generally, under an increasing oil price environment, you get an increasing interest rates. And we're also seeing interest rates break out to the upside here. So everything's in alignment. Everything is agreeing with each other. So come on down. It says the commodity super cycle is a sequence of price spikes with each high higher and each low higher. Yeah, higher lows and higher highs. I completely agree with them. It says that could use up as much of the unused capacity global producers have, which will send prices higher. He reiterates that OPEC Plus will unwind production limits and look to raise output later this year. An OPEC Plus market monitoring committee this month recommended that the group keep oil output unchanged. It says, right now, we're still balanced to a surplus because China has still yet to fully rebound. And in the dark here, it says, are we going to run out of spare production capacity? Potentially by 2024, you start to have a serious problem. That is what we are invested for, right there, if you're an oil investor. Coming down, so Freeport. We got Freeport's now bringing in more natural gas than it has for months, finally. So this is the daily feed gas deliveries for Freeport LNG. We can see it's turning back on. And I think this will be a tailwind behind natural gas prices. And I know people look they kind of look at these markets individually. And what I mean by that is they look at natural gas, oil, and coal and uranium individually. But as one or two of these energy, we'll call it supplies, becomes short, I think we need to look at these things as everything tied together. A coal shortage will eventually be a natural gas demand, or an oil shortage could be a demand for something else in the system. So when we get a shortage of one thing, and I think coal is going to get really, really tight. I think we're going to burn more natural gas, which then that's going to get tight, and then we'll burn more oil, but that's going to get tight, and the whole energy, I'll call it the whole energy arena is going to get tight at some point, and prices are they're all going to go higher. It says the Fed is playing with fire. Despite the recent rate hikes, financial conditions remain way too loose. This is typical of an early inflationary cycle. The longer inflationary forces persist, the harder it will be to expel them from the system. So this is the Taylor rule to the Fed funds rate spread. You can see it's very high, much like the 1970s. So it's still far too loose, according to Tavi. Coming on down. Oh, I'm sharing this. This is our conviction in the bull case for oil has never been stronger. I agree. Mine too. George says M2 money velocity is going up. I'm in the disinflation camp, but this is a good argument for inflation, assuming M2 stops declining. I don't hear many talking about this. Well, I think what's driving this increase in M2 money supply is they created money to buy assets, and now they're unwinding those assets. And them unwinding those assets will impact whatever assets they held. That M2 money supply does not circulate through the system. So they're taking money out of the system, but it's not the money that's been circulating in the system. So your M2 money velocity would increase because they're not impacting the money that's flowing in the system. They're only impacting the assets that they're reducing on their balance sheet. If they sell those assets, those dollars go away. So yeah, they created a bunch of money, but I don't think it's money that's having an impact on the consumer price index as much. That money will stay out there. And the consumer price index, that level will stay high. It'll stay elevated. I don't think it will have a huge crashing move lower. This guy says, did they just figure this out? It says White House says Russian oil output cut shows Putin willing to weaponize energy. Yeah, no duh. Yeah, I did a podcast with Ben, so check that out, definitely. Here's one. It says the interest expense on U.S. public debt rose to $783 billion over the past year, a record high. If it continues to increase at the current pace, it will soon be the largest line item in the federal budget, surpassing Social Security. So yeah, look at the interest expense on the public debt. Outstanding. This is going to continue to increase if interest rates go up. They're going to get themselves in a problem. So with as much debt out there, and if oil does what we think it's going to do in 2023, 2024, and really take off, I think interest rates will go up. Because inflation, the majority of the CPI is linked to oil. Oil is one of the components of it, energy prices, but everything is a derivative of energy. And if energy goes up, all those other things will go up. The only thing that might stay, we'll say, sideways if interest rates go up is housing, which is also a component. So I think interest rates will continue to go higher, the potential for them to go higher. Here's Eric. He says, the hardest part sometimes is just to sit on your hands and not trip over pennies on your way to dollars. Exactly. That's exactly a good quote there. Now, this is from the CEO of Camco. It says, demand for nuclear power is driving the best fundamentals ever seen. Tim Gitzel, CEO of Camco. So you can check that article out. Fundamentals for nuclear, best market ever. Now, here's something. It says the best investment advice I ever got. So let's take a look at it real quick. It says the best advice I ever got was on an airplane. It was early in my days on Wall Street. Flying to Chicago, sat next to an older guy. He says, if you get interested in a company and you read the annual report, he said, you will have done more than 98% of the people on Wall Street. And if you read the footnotes in the annual report, you will have done more than 100% of the people on Wall Street. I realized this right away, that if I just literally read a company's annual report and the notes, or better yet, 2 or 3 years of reports, that I would know much more than others. Professional investors used to sort of be dazzled. Everyone seems to think I was smart. I later realized that I had to do more than just that. I learned that I had to read the annual reports of those I am investing in and their competitors' annual reports and trade journals and everything I could get my hands on. but I realized that most people don't bother even doing the basic homework. And if I did even more, I'd be so far ahead that I'd probably be able to find successful investments. And that is what I actually read. I don't read the annual reports. I read their presentations that they have for all these companies. And that's kind of where I look. I look at the technical analysis and I read the company's presentations. The annual reports is kind of a backward-looking way. What I like to listen to is the CEO on YouTube, if they've got any sort of information that the CEO or presentation that they're giving and their outlook of what their business could potentially do. I am more in the camp of outlook than I am in the camp of looking backwards. What he's doing here, I think, works incredibly well with companies that control the selling price. And obviously, you can glean a lot of information from looking at the annual reports as well. But yeah, that's it's good to know a lot about the companies themselves. Now, here's oil inventory is down 1 million barrels per day last week after a monster 3 million barrel per day draw the previous week. That equals 27 million barrels drawdown in 2 weeks. Now, I know Jeff Curry said that we are kind of in a surplus. This surplus is happening in America. The deficits are happening on a global scale. So it says global crude inventories are 6% below 2019 levels despite refining maintenance. And as global product demand continues to tick up, invest accordingly. And we've also got refining down, at least in America. That's why we're seeing gas prices go up, at least in Colorado. But gas prices going up, that means that you're going to have less demand for oil because you're converting less oil into gasoline and diesel if your refiners are doing maintenance. Says these are among the most favorite investments. Small, aggressive new enterprises that grow at 20 to 25% a year. If you choose wisely, this is the land of the 10 to 40 baggers and even the 200 baggers with a small portfolio. One or two of these can make a career. That's exactly what how I invest. And I got lucky because I got a bunch of 10 and 40 baggers in the portfolio right now because I went in really early in 2020 in a lot of these oil and gas exploration production companies. So I did luck out, and my portfolio has grown substantially because of that. And on some of these companies that return that amount. So he's completely right. And you don't need a lot of them to transform a portfolio if you put a 5-6% position on it, or even a 3 or 4% position. I mean, a 10 bagger, a 10 bagger with a 5% position basically doubles your entire portfolio on just the one position. So yeah, they can grow. And if you get a 30 bagger and you put a pretty good stake on it, yeah, you can get, it's massive. It changes your life. But yeah, that's what I've got for today, guys. I just kind of wanted to go over that and share. I am looking forward for energy. And here's the tough part, though. You know, if energy works that well, I don't know what else is going to work that well. I mean, you could look at maybe precious metals, like the physical metals. I think they would do very well under a condition like that. But usually in an increasing interest rate environment, much like 2021, you'll see commodities do well, but there's not much else that's going to do well in the market. I don't think stocks will do well, like regular stock market, like S&P 500, because if interest rates are going higher, that's going to be a huge headwind over the next years, I should say. Doesn't mean they can't go higher. I just don't think they'll go up as much as the commodity complex. So given the market conditions looking forward and the interest rates, I think commodities and maybe precious metals are the only play in this in the game here. So yeah, I'm overweight in those things for sure, and I'm going to be riding those up over the next few years. Really excited about what's coming in oil. I'm a big oil bull. I like oil a lot. I think it's a good, solid, reliable way to play a commodity bull market. And I think some of the other sectors are a little bit harder. I think the companies aren't as strong. I don't think they're cash flowing. I don't think they have the infrastructure in place. I just don't think they're as reliable as a play. So I like energy quite a bit. And I like energy service companies quite a bit right now. All right, guys, that's all I've got. And if you guys have any interest, definitely check out the website. the Platinum membership, use the word discount in the coupon code if you guys want to know what companies I'm using to play this bull market with. We do, oh no, that's, we're going to have a Saturday 7 a.m. I'm trying to think because this is going to be released on Monday. We're going to have a Saturday 7 a.m. Mountain Standard Time release for the next weekend coming up for the Platinum members question and answer session. Thumb up for the content, subscribe to the channel. We'll catch you next time. This is Finding Value.